Welcome, ladies and gentlemen, to another episode of Buy the Dip. I'm very happy to have with me today a familiar sounding accent all the way from South Africa, Arno Venter. Arno, thank you for joining us today. I really appreciate you coming on, giving up your time. I really enjoy your research on Twitter. And if you're not following him already, you really should be, because he really does share super insightful stuff. And today we're going to be looking at some major themes. So as I like to do normally, Arno, I like to start off with getting a little bit of a flavor for the background of the person I'm interviewing. So without further ado, tell us a bit about yourself, how you got into the world of finance, and a bit on your background and what you're doing currently.
Perfect. I mean, first of all, thanks for having me. It's a real honor. Based on the previous guests you guys have had on, I kind of feel out of place. So it's great to be here, first of all. In terms of my background, mine is slightly different when it comes to the analyst side of things, because at the moment, as you know, I'm one of the senior analysts at Financial Source. I've been with the company now for, it's probably close to 4 years, but I didn't come through the traditional channel of going from an institution, moving into another institution. So I actually came from the retail side. So my journey has been slightly longer than the normal trader out there. The way that I got into trading, about 8 or 9 years ago, a friend dragged me to a trading seminar. And it was one of those seminars that promised me that I would get a Lamborghini in something like 3 months. So unfortunately, I never got the Lamborghini, but what did stick around was just a tremendous passion for the markets. Because before I did that, I didn't really, I knew, markets existed, but it wasn't really something that I actually thought about, going through school and through varsity. There was really nothing, it didn't even cross my mind. So that sort of set in motion just a long road of development, and went through a couple of different courses, mostly on the technical side. And it always felt like there was just something more I wanted, something that I was missing. And for me, that was really the macro fundamentals. And I heard of this company at the time called Forex Source, which was now probably 4.5 years ago, which provided like an induction type of course. And I thought, well, it's fundamentals. I want to learn it. Let's get involved. And the rest is history, really. I went through that. It was just mind blowing how, everything just broke open, like understanding the reasons for why the market moves, etc. And after going through that, they liked my research. So they asked me to do a couple of writing projects for them, which they liked. And they gave that through to the subscribers, basically, and they liked it and the team liked it. So they asked me on board, and that was 4 years ago. And today, sitting in the senior analyst role, which is just absolutely awesome. It's a dream come true. From where I started back with the seminar that promised me my Lamborghini.
The Lamborghini. That's quite a story. I never knew that. Very interesting. And that's why I like to, at the beginning, get a bit of a flavor and background for the guest's history in terms of financial markets. So that's great. I hope I haven't cut you off earlier. Is that answering?
Yeah. That's that. Yeah. The rest is history, as they say.
Yeah. Okay. Well, question number two. So knowing what you know now, looking back, what is the one thing you wish you could have told mini Arno coming into financial markets when you're starting out? What's the one thing you might have been able to go back in time and change or tell?
It's probably going to be different for most traders. I think for me personally, it would have been, if I could, I would have started with a macro fundamental backdrop first before I went into the technical aspect, because you need both in your trading. You can't just rely on the fundamentals if you don't know where to enter and where to exit, where to define risk, etc. But I think for me, the way that, every trader is different. So the process that just clicked for me was the fundamentals. So if I could go back to 8 years, instead of going to that trading webinar that I went to or seminar that I went to, I would probably have been better off going to like a fundamental one that starts you off on the right track, as opposed to, promising you this miracle system that it's just a bunch of nonsense. So I think for me, it would definitely be starting with the macro fundamentals, getting that basic structure. And with that, I don't mean like just raw economics, because that won't really help you in the trading game, right? You need to, there's a big difference between understanding economics and understanding how macro fundamentals impact the market. There's a lot of theory out there about how things should and shouldn't work. But the moment you try to trade that theory, you end up short. You're like, man, but the textbook says it should be this or it should be that. So I think that practical macro fundamental knowledge would be what I would start with if I could do it all over with, instead of going the other way around.
Okay, very interesting. Yeah. I mean, I obviously got an economics background, my degree, but I hear what you're saying. There's so much like theory you can actually get lost in. And sometimes, like for instance, purchasing power parity, currencies can remain very dislocated and disconnected from those fair value measures. So it's not always, right? I mean, for years. Yeah. Arno, next question. What are some of the biggest tips that you could give to new traders as well as major pitfalls to avoid?
The first one is don't try and catch every move. You're going to try to in the beginning. You're going to hope that you can, and you're probably going to get frustrated when the market moves without you, and it's something that you didn't even have it on your radar. But don't try and catch every move. It's impossible to do, and it's unnecessary, really. I mean, if you have a process that works, you don't have to catch everything, right? You just have to catch the right one at the right time, the one that you were waiting for, preparing for. I think that's the biggest one for me. The biggest lesson that I had to learn was that just relax, play the game that's in front of you. Don't try and watch and play every game that's going on beside you. Focus on what's in front of you, your process, and just stick to that. I think the other big one for me as well was, embrace from an earlier start things like automation. So there's so many things that I used to do manually in the beginning that I wished I knew there was ways to do certain things more automatic. So I would probably embrace that from earlier on. Looking at data providers, for example, instead of going through a bunch of raw data every single week or weekend, find ways to automate that for yourself, because it's machines can just do what we do so much quicker. And it's easier to have the stuff available as quick as possible as trying to, be clever and figure it out on your own. The machines are there, use them. I think the other one would be, buy the dip, right? And what I mean by that is, don't
name of the show.
Yeah, don't overthink it, just buy the dip. And for me, that was a really, really big lesson to learn in the beginning. I thought I was going to be the most clever trader, out there, the next George Soros. And it's just not the case, right? The moment when you get thrown into the market, you very quickly realize, wow, I'm actually not that clever, as clever as I thought I was. And what I did in the beginning, I tried to just unnecessarily overcomplicate my trading process. Had a million things I wanted to look at and a million things I wanted to figure out. And, if you drill it down to the raw basics, even a very simple momentum strategy can work if you just get in at the right time and ride the wave. So I think don't, as much as you can, don't try to overthink it. Sometimes buying something because it's going up is the right strategy.
Or buyers and sellers.
Yeah, exactly. So don't try and be, outsmart the market. There's just way too many smart people out there to do that consistently. I think the other one is, be careful of hindsight. So a lot of, I could have probably avoided some of my biggest losses would have been avoided, or frustrations would have been avoided, if I understood that I need to control my emotions when it comes to hindsight. Because what happens is, in the heat of the moment, when you're looking at the market and you're deciding whether to get in or potentially get out of a trade, you make the decision based on the information that you have at that time. But what happens often, our minds play with us, because now a day later or 2 days later, you dumped your position. And when you look at the screen again, it's 200 pips higher. And then you're like, man, I knew I should have stayed in the trade.
Yeah.
Or you don't get in it and you're like, man, I knew I should have gotten in at that time. What a good tip is, if you're just starting out, write down why you make decisions and stick to it, because tomorrow, in a week's time, in a month's time, you're going to forget what you were looking at the time in real time, and you're going to create bad habits for yourself. by relying on hindsight, because it's an exact science, right? It's easy to know that I should have stayed in after you saw the move happen in the right direction.
Yeah.
So I think be careful of hindsight in the beginning. If you're just starting out, I'm not saying, have a rigorous journal or whatever. That is helpful, by the way. But, at least just write down your decisions. If you're in a trade or planning to get into one, you don't have to write a 4-page essay, just a couple of bullet points saying, I don't want to get in right now because XYZ, just that. And then tomorrow when it's moved in that direction, just have faith in your own process that I looked at these things. Okay. After which you might say, maybe next time I should add this into my process, or maybe I shouldn't be as critical of this component or whatever, maybe you're overanalyzing something. And that is obviously what the process is there for, but make sure that you're sticking to the right process. Don't listen to hindsight, listen to your trading process that you have. And I'll say the other one is, conviction. In trading, we always talk about conviction, a low conviction trade or a high conviction trade. It's important to know that high conviction doesn't necessarily mean more success, right? Because when you're talking about conviction, you're basically talking about your own interpretation of the data that's available. And sometimes our own interpretation can be skewed by that. So, if you are adjusting your risk for any type of trade, make sure that your risk adjustment isn't built on subjective conviction that you have in the trade or low conviction. Have a process that looks at objective information that you can use for that. So for example, if it's a super low volatility environment, you could probably afford to risk a little less. You could probably afford to give the trade a little less room to breathe, if that makes sense, especially if you're targeting a specific R2R. And I mean, these days I'm not as strict in terms of risk reward. It's more a volatility adjustment, really, So conviction is great, but in the beginning, if you're just starting out, there's a high probability that your conviction is wrong.
Yeah, that's true.
That you might think this is the best trade in the world, and an hour later you might find out that it wasn't. So conviction is great when you've got the experience to back it up. When you don't, stick to a rule, stick to a process, something that takes your subjective conviction out of the way, and find something where you can adjust your risk based on data instead of your own feelings, basically.
Okay, perfect, Arno. That was a good roundup there of the major pitfalls and tips for new traders.
And so I've got the t-shirts in my closet, though. So I've got a t-shirt for every one of them. So it's learned by pain when it comes to these
pain. Getting into the real nitty-gritty now, the strategy side of things. So question number 4. What do the Fed do? They're, in my opinion, they're in a really tough position here. Their tools that they have can't really do anything for supply shocks, and they really seem laser focused on inflation, which is the problem right now versus the problem of a potential recession, i.e. the future problem. They can't do anything against surging energy prices, can't drill an oil well. The labor market's structurally very tight. So would moving aggressively and slamming on the brakes actually prevent inflation expectations from surging and problems there? And in my opinion, and you can obviously shed light on this, is the only thing that I think they can really do is they can synthetically create a recession and cause a hard landing here and try and create that demand destruction to try and get inflation lower. What, in your opinion, do you think they have to do here, Arno?
I mean, when I saw this question, I laughed because it's like we shared notes when it's almost like we shared notes
telepathically.
Yeah, I mean, you know what, I 100% totally agree with you. I mean, the reason why the Fed needs to move right now, apart from the fact that they got inflation wrong, alongside the majority of us, I suppose, apart for that reason that they need to move right now, is because they politically, there's also a lot of drive for them to at least try and do something to bring inflation down. And I mean, they've said, how many times have they themselves told us, listen, our tools can't fix this. But then during the press conference, they will say, we have the tools to fix this. So, do you or don't you have the tools? So they know they don't have the tools. I think everybody knows they do. And I completely agree with you. The only way, I do think they can bring inflation expectations down, but the question is, at what cost will they need to bring it down? Because the only way at this stage that they can fix it is by damaging demand enough to basically even out the supply and demand issues that we have right now. And that, whether it leads to a recession or not, I mean, you can do a lot of damage before you get to a recession, but I can't see them escaping that as a way to get there, mate. I think right now their hands are tied. They know they need to come in as aggressive as possible. I mean, whether they get to 9 hikes, that's debatable this year.
Yeah.
But I don't see another way. If they from their side want to bring it lower, it's going to have to be demand destruction.
Yeah. I think, in hindsight, and this is what you're talking about, is one of the tips and pitfalls to avoid. In hindsight, they probably should have just maybe rather done a gradual, more spread out tightening cycle, normalizing it, because now they've left it because they got inflation wrong. They're going to have to slam on the brakes. And it's all well and good saying, well, maybe energy, maybe supply chain disruptions, they're going to dissipate. But the labor market is structurally tight. There's lower participation rates. People have retired earlier. That's not going to go away, unfortunately.
No.
And but anyway, okay, glad we're in agreement there. Telepathically shared our notes, Bluetooth from London to Hearties. Arno, in the past, the dollar tends to peak around the beginning of the Fed's hiking cycle. Do you think this time, and I love this phrase, could this time be different? If you do think that's the case, what is the reason for it? Or maybe you don't.
Yeah, so I mean, I'm very rarely the guy that says this time could be different, but I do think this time could be different when it comes to the dollar cycle right now. I mean, we've seen a lot of upside for the dollar already, and most of that until now has been driven by the Fed, right? Majority of it has been driven by that. There was also some positioning issues which kickstarted the move already back in 21. So there was a lot of reasons for the upside, but I think it's safe to say that inflation in the US and the policy as a result of that has been the biggest driver for the upside that we've seen recently. The reason why I think that strength could continue, as long as they stay on that course, is growth. I mean, if you take a look at growth, what's interesting from past cycles, especially if you take a look at 2018, if you look at the dollar's trajectory through that time, it was also a cycle where the economy was expected to slow already. You had a Fed that was super aggressive at that time, very hawkish. Back in November, when the S&P started to collapse, they were still, in their December meeting, they were still saying, yeah, we're going to hike 4 more times in 2019. And then in January, they came out saying, actually, we're not. We're probably going to stay on hold now. And eventually they started cutting 6 months later. Now, if you take a look at the dollars, where the dollar is different from most currencies is that for any other currency out there, if you have an environment where your growth and your inflation is slowing, that's normally negative for your currency. When it comes to the dollar, because it's the reserve currency, because it's so closely tied to global growth, whenever something happens that slows down that growth, it synthetically creates demand for the dollar. So if you go back to any cycle where growth was massively falling, that has been a dollar positive environment. So I think if anything will make this time different is that if growth slows enough, the dollar will catch a bit. I think we've already started to see some of that. If you take a look at key economic metrics like personal consumption, personal income, retail sales, industrial production, consumer sentiment, if you take a look at all of them over a 6-month basis, with the rate of change, all of them have been slowing, and they've actually been slowing for the last 5 or 6 months. Not because the economy was doing bad, just because from the levels where we were coming from, it was just natural for us to slow. But the slowing has now started to accelerate a little bit more in the recent data. And I think if anything will make this time different, it's going to be a growth environment that is not expected right now. And some of the recent data, we can look at it a little bit later on, but some of the recent data has been super slow. The deceleration has been much faster. We're looking at recession levels for consumer sentiment, and what makes the US economy slightly different than some others is that it's 70% consumer spending, right? So if the consumer is suddenly feeling a little bit stressed and inflation is starting to bite, then it's only natural for those things to slow. And what's been interesting, if you take a look at the Fed, they are super focused on the labor market, right? All of them have said the labor market is solid, the labor market is strong. And even though it's tight, even though it is strong, that's normally a late cycle indicator. So that is one of the last areas that you expect the slowdown to show. So it's very interesting that they chose to, fixate on labor instead of fixating on personal income or consumer sentiment or retail sales or industrial production. Even the ISM reports, I mean, it's been looking bad recently, so I think if it is going to be different, it's going to be growth this time. That stays the bit. But like we saw back in 2019, if the Fed then comes out and we eventually do see a pivot, a dovish pivot, a put from them, dollar down, equities up massively. That can, I think, from a medium term perspective, those are the types of trade where if you wait for them and you time them correctly, it's going to be trades that you can hold for months and trade them, in line with that eventual pivot that we do think will eventually need to happen.
Arno, do you think that the Fed pricing, though, that could maybe be a potential? Because I agree with you. I think we're going to see a synchronized growth slowdown, and obviously the dollar and the US economy, relatively speaking, too, is the cleanest dirty shirt, so to say, compared globally. Yeah. But do you think that the Fed pricing, although they're probably also one of the most hawkish banks on the street too, relatively speaking, do you think it's gotten to the point now where it's completely priced and that's actually going to start to turn and potentially be like a downside risk to the dollar, that it's so fully priced now that if there's any disappointments on the data side or any pivot by the Fed, that's going to lead to a weakening of the dollar? And don't forget one more thing. We've got that US November midterm election in November, and the betting markets right now saying the Republicans are going to get a clean sweep. And that's not really a dollar positive because, that they're gridlocked from a fiscal and legislative perspective. So I just wonder if maybe towards the back end of this year, we could actually see the dollar maybe roll over a bit because of that full Fed pricing.
If growth takes a big enough hit, they'll have to pivot, right? I mean, they've had to. I mean, both Powell and Brainard were called into the principal's office, in November, and after that, miraculously, they started to fight inflation. So a lot of the pivot has been political, and right now they need to fight inflation, and they need to be looking like they're fighting inflation going into November. But if they allow the economy to take a beating, and I mean a proper beating, they'll have to pivot. And the moment they pivot and they provide the markets with that infamous Fed put, I think the dollar is going to struggle to stay strong in that environment. Really struggle. Okay. In terms of stir pricing, I think everything is overpriced right now. If you take a look at the Fed,
that's one of the questions we're going to get to later on the show.
Yeah, let me not jump the gun.
Yeah, don't jump the gun, Arno. Come on. All right, that's enough about the Fed, but it'll be interesting to see which factor plays out. This aggressive Fed tightening plus the November midterms versus a synchronized slowdown in growth. Maybe the dollar might actually go maybe flat. We might have that sort of recessionary fears bidding the dollar, and then we've got the pullback and rate hike pricing, and then the dollar negative of the midterm election. So it might just be these sort of opposing forces, but definitely got an interesting year ahead. That is for sure. Arno, next question. Number 6, we're moving out of FX now. We're going into commodity land, gold. So gold price action has been very interesting lately. I've found it very perplexing, but I kind of have some reasons as to why. I'll be interested to hear what yours are. Why is there this disconnect between, where it should be trading based on real yields? What, in your opinion, is driving it? And are you bullish or bearish on gold's prospects?
Yeah, I mean, I'm bullish gold, medium term.
Okay.
I mean, what you're talking about in terms of real yields and nominals, it's staggering, right?
It's like 300. I think it's like $300 an ounce is where the premium is to fair value at the moment, which is like a multi-decade high. Yeah,
it's crazy. I mean, it's crazy. We've been spending a lot of time on this over the last 2 or 3 weeks or so, especially since that divergence started to kick in. And I think what's interesting about where we are right now is, again, from a cycle point of view, what's interesting about both gold and the dollar is they share similar characteristics on the growth side. So I know there's a lot of a lot of talk about gold being an inflation hedge. And, you know, when we have a beer sometime, I'll tell you exactly why I think that isn't the case. But in terms of gold, apart from yields, I think the only reason why we haven't seen that reaction, that normal reaction, because right now yields are either telling us that they need to be, you know, massively lower, gold needs to be massively lower, or it's telling us that there's something else driving gold prices right now, that it's not the move we're seeing in nominals and reals, which is mostly driven by inflation right now. I think right now it's a growth story that's developing. I think apart from the geopolitical side, of course, you know, geopolitics as a hedge as well. But I think what gold is showing us right now is gold is figuring out what I do think nominal yields will figure out eventually. That's that we are in a slowing environment right now. And if you go back to all of the previous cycles, whether recession or not, it's normally had a positive return for gold in these types of environments. So I think it's a growth story that's driving gold right now. I mean, we are currently long it as well, and we'll see how it pans out. I think if inflation, you know, if we are at 12% inflation in 2 months' time, I don't know how long gold will be able to keep up, even if it is more of a growth hedge, in my opinion, than an inflation hedge. I'm just not sure how long it can keep up with this move in yields. I mean, I'm just looking at this chart. I mean, reals and nominals, it's just ridiculous, right?
It's like almost, it's gone almost, we like just over 10 basis points away from being back to flat on US 10-year real yields, you know?
And gold is flat. You know, it's completely flat over the last,
So I agree with you. I think it is like a bit of a policy mistake, growth slowdown hedge. I think you've seen that in sort of the spreads on curves further out and in interest rates, euro, dollar, 2023. I think you start to see cuts starting to be priced in early 2023. I think maybe also weakness in crypto. That maybe I'm thinking pre-invasion levels. I'm thinking pre-invasion levels, obviously, because, you know, a lot of gold price rally that we saw recently was that geopolitical risk premium being priced in. Yeah. So, but I just wonder how much it can remain above its fair value and how long this dislocation can last. So it's been incredible. Arno, back to FX, US dollar JPY. You know, I wrote these questions at the end of last week, and we've seen today it's through the 125 level. It's been surging like a meme stock. You know, being a large oil importer and having a close correlation with US 10-year yields. That's sort of been the driving forces behind it. And obviously the Bank of Japan is just buying unlimited quantities of bonds to keep their yield curve target in place, at 0.25%, the upper band. Yeah. And we're beginning to hear some jaw boning from policymakers. How, in your opinion now, do you think, with the levels where we're trading at currently, do you think the risk reward profile is for the US dollar JPY, number one? And then if someone does want to jump along for the ride, how would they trade something, you know, which has risen so rapaciously and rapidly? Would they wait for pullbacks for a better entry, but then at the same time it could leave the station like you're getting a ticket on the train if you try and do that? Or does one just try and, you know, ride the momentum and use like a trailing stop loss? How would you structure it, Arno?
So, I mean, I'm going to answer this in two answers. The first one is specifically dollar yen, and then talking about these types of moves in general. I think when it comes to dollar yen, I mean, disclaimer, I completely missed this entire move to the upside, right, in yen pairs. And it wasn't because I wasn't looking, but it's because of that normal, massive, sharp inverse correlation that we have with yields. So because I've been so focused on the growth side, I've been expecting nominal yields to catch the growth story, or to move from inflation focus to growth focus. So really from, 4 weeks ago, I haven't been trading any yen pairs because I've been very reluctant on, chasing it lower, even before the massive run higher, reluctant on chasing it low, the yen lower or the pairs higher, because of my concerns for nominal yields. Because I do think if it wasn't for inflation that got an additional boost with the geopolitical stuff, I do think the growth story would have gotten more attention from the bond market. So I've been patient with it. And my feeling towards dollar yen right now is that where we are, the more data we get, the more the concerns about growth is going to start to creep in. And eventually I think yields is going to wake up. Now, I've been wrong on yields from, February, so early January. So, I mean, take my take on yields with a big pinch of salt. But that's the only reason why I'm reluctant to jump into it, because even if it doesn't change my medium-term bearish bias on the yen, based on, like you said, many different factors, if we do see a massive run lower in yields, from a pure correlation point of view, it should alleviate some of that pressure we have in the yen. So that's been keeping me patient, right? In terms of these types of moves, it's always a challenge when you trade the headline grabbers, right? Because it's been my experience, right, that if you trade these moves, if you're not in it for the right reasons at the right time, you're going to get burned somewhere. If you take a look at oil, there's so many people that jumped in afterwards saying that this ticket, this thing is going to 150, just buy it now, don't look back, just to be, flushed out a week later, right? So I think when it comes to these types of massive volatility moves, if you're in it from the beginning, fantastic, then just ride it out, with a trailing stop, like you said, just ride it out and see how far you can push that momentum. In terms of jumping in now, I think waiting for either a big pullback to flush out enough of the weaker bull hands is probably going to be the best course of action on any type of move like this. Waiting for the weak hands to be flushed out, I think, is a good call. The other one, though, if you look at these types of moves now, I do consider myself sometimes a contrarian trader, but I'm not the guy that's always trying to just take the other side of the trade. In this example, though, I think if anything will make me trade the yen, I'm going to stay patient on the short side because of yields. But, if we start to see yields pricing in the growth slowdown that we're expecting is going to come, I would consider some potential shorts on something like dollar yen. Well, maybe not dollar yen, because the dollar is expected to be supported, right? So I would probably choose a different pair, but probably CAD yen or something like that to express that view with. But the other thing to wait for is we're not far away from 130. I know it's 500 pips away, but if you take a look at this run that we've had, we're very close to 130, and we've been hearing that jawboning about the 130 level. I think that's the new line in the sand. I think if we see that first shot across the bow from Japanese officials coming out saying that this is enough, we're going to have to do something, even if they don't do anything, if they just come out strong enough against it, I think I would actually look for some shorting opportunities in yen pairs. But for now, I'm patient. If you take a look at the jawboning that we've had, they haven't really talked massively against the weakness, which has been quite. I don't know if you noticed that they came out saying that we're noticing it, but they haven't really said we don't like this level, right? I think they like where it is. It's helping them on the inflation for the first time in 30 years. They're probably going to have some inflation, So I think they like it weak. But I think 130 being a line in the sand could be a possible area to get involved with. I think this most recent pullback that we've had, I think the bulls that got in at the right time took some profit there when we heard those first comments coming out. Because even though they didn't talk against the move, it showed that the yen move it's been getting the wrong type of attention. And that should make some of the bulls uncomfortable. But, where we are right now, I have no appetite for chasing it. I missed the move, and I'm okay to miss it. What I don't want to do is get in now at like a compromised position and then regret it in a week's time when yields roll over, and if yield starts to push lower and, Japanese officials come out. I don't want to be long at these levels. So for me personally, you either grab it from the start or you wait for a big pullback. And the risk, what the risk is that normally we say we're going to wait for a pullback.
Yeah.
Let's just say we do get one. What if by the time that we get that pullback, what if the conditions have changed?
Yeah.
So I'm always very careful to say that I'm going to buy on a pullback, because I want to, my rationale might change for the reason for the pullback.
Yeah,
if it's coming back for the wrong reasons, I don't want to get in. So it's a challenging one, this one. For me, I'm happy to be an observer for now with dollar yen.
Okay, perfect answer there, Arno. And as we spoke about earlier, the pricing, we finally arrived to it now, so you're not jumping the gun anymore. So where do you think the consensus is most wrong with regards to STIR's pricing? Do you think it's the BOE, ECB, or the Fed? And how do you think this may impact those currencies as a result?
Yeah, I think this has been a very interesting year because I can't recall from even prior cycles where the market, I think, has been wrong on so many fronts when it comes to STIR pricing specifically, right? It's like everything is wrong. If you take a look at the Fed, if you take a look at the Bank of England, the BOC, the RBA, the RBNZ, I mean, you know something is wrong when STIR markets is pricing in 2 hikes for the SNB by the end of the year, right? Then you know there's just too much aggression in terms of what they're pricing in. So the way that I normally look at it, when everything is going through through something like this, I think it's always important not to look at it from an absolute level, but to look at it from a relative value. So if and when STIR pricing starts to correct, if we start to see markets pricing in more realistic, rate paths, where do I think, which currency do I think has the most to lose in that scenario? I'd say 3 jumps to mind. The first one would be, and we've already seen a lot of that, has been the Bank of England. I mean, we were cautious pound just before the February meeting when we said that, given where we were at that time, we felt we were very close to a peak hawkishness scenario because the economy was expected to slow, and that wasn't a surprise. Everybody expected activity to drop lower. Not everybody expected inflation to accelerate even higher, but for us, it was like, if you look at it from a sine curve, I always explain it in a sine curve, that where we were in February for the BOE was that the economy was at its peak. It wasn't going to do any better. It was probably only going to do worse from there. And the market was pricing in 9 Bank of England hikes just like 4 weeks ago.
Yeah.
And then suddenly we saw the pound just dump because the markets realized, whoa, we've probably reached peak hawkishness. And now we're on the backside of the sine curve now when it comes to the Bank of England. I think the next one, in my view at least, that's going to go through that is going to be the BOC. I think the market is way too aggressive on it. I think if you take a look at 9 hikes priced, I mean, the market is pricing in a very similar aggression from the BOC compared to the Fed. And sure, if we get a 50 basis point this week, we're probably going to see the CAD supported, especially if they come out talking up the possibility of another one. But ask yourself this, based on where we are with the Canadian economy, we're probably very close to peak before we're going to start rolling over and seeing more signs of that in the data. So if we're at the peak or close to it at least, and the market is pricing in 9 hikes by the end of the year, I see a lot of potential downside for the CAD, especially since the CAD is trading at, if you look at it from an index level, it's trading at 2015 levels right now. We've seen a massive appreciation. Yeah. And I think the markets have gotten ahead of themselves with the CAD. Relatively speaking, again, I think that's where the most unrealistic expectations will hurt the most. I think it's going to be pound. We've already seen quite a lot of that. So I wouldn't be chasing it, on its own for that reason from here. I think the growth picture will still, be bad for sterling going forward. But I think CAD is one to watch. You can also argue the RBA because we're pricing in 14 hikes between now and the end of next year. I mean, STIR markets are smoking something if they think we're going to get to 14, right? 14
smoking twigs, twigs and hearties over there.
Yeah, I mean, proper. It's just,
And the ECB, do you think the market pricing in 225 basis points hikes by the end of this year from the Eurozone economy, do you think that's too punchy?
You know what? For once, I'm going to actually say that. I mean, I was a bear for the euro for a very long time, but I do think, relatively speaking, if you reprice from 2 hikes to no hikes versus repricing from 9 hikes to, let's say, 5 hikes or 4 hikes, I think that they have a higher chance of reaching 2 than the BOC has of reaching 9.
Okay.
Which doesn't mean that we get to 2, but let's just say we get to 1. There's not going to be that much of a difference. If you take a look at where the euro is trading, it's almost like I think from a STIR point of view, your risk to reward is the most attractive on the euro side right now, because that's probably where the market is the most bearish in terms of, we've all seen it. I've been guilty of it. The ECB will never get to 2. They'll never get to 50 basis points. We'll never see this happen. Okay, fine. But for the same reason, I don't think the BOC gets to 9. I don't think the RBA gets to 14, by the end of next year. So I think there's a possibility we get to 2. I mean, it's alongside the growth picture, it's probably going to be negative eventually for the currency. But if they can avoid recession for whatever reason, I don't see them not being able to go to 2 based on where inflation is at right now.
Okay. Well, speaking of the RBA, we've actually got, that's the next question. Do you think the market's incorrect in the expectation that the RBA will hike June of this year? And last time I checked the stir pricing for the RBA, it was 8 by the end of this year.
Yeah.
What do you think the implications are for AUD? Do you think the RBA is going to buckle under market pressure and hike, or do you think the market's completely wrong?
Sorry, yeah.
Or the market's completely wrong? Do you think the market's completely wrong, or do you think the RBA is going to buckle and match the market, or do you think the market's just totally wrong here?
I don't think they match stirs. I mean, it's just it's just way too aggressive. I'm that guy from the ECB now, but for the RBA, there's no way we get to 8. There's no way we get to 14. So I don't think we get anywhere close to stirs, but I do think they're going to pull the plug, the trigger rather, in June. I think the reason for it is they've had reasons to hike for the last 2 months. What was quite telling for me from the February meeting. I mean, we've been bullish the Aussie. We've been trading it along from the February meeting. I think it was the 1st or the 3rd of Feb. Directly after that meeting, I went long Aussie, and my rationale for that was, okay, they see growth accelerating and staying solid for the rest of the year. At that time, we were also seeing really good signs from China. So the short term on China has been looking, slightly less positive with the virus situation. But at that time, China was responding, favorably, more stimulus from the PBOC. That's obviously very important for the Australian dollar always. In terms of the RBA themselves, though, they were looking for growth to accelerate. They were looking for wages to hit their target within the next, what's it been, 12 months. Inflation was expected to be above target for 2 years. But they were saying at that time, we want to wait until inflation is sustainable within our target. So, okay, what is 2 years? Not sustainable is the next quarter. But if you think you're going to hit target for the next 2 years rolling, you've reached your target. What are you waiting for, right? So yeah. I think they've ran out of reasons for not to hike. I was quite surprised last week, though, by the market's reaction to the RBA. I thought they were, even though I'm bullish the currency, I'm not bullish it right now. I got out of my last AUDCAD position, I think a week or 2 weeks ago. I think the markets overreacted to the Aussie, to the RBA, because suddenly they were pricing in, I don't know if you noticed that, just after the meeting, they were pricing in an 80% chance or probability of a 25 basis point move as soon as May. Now that was just ridiculous, because there was conditionality in the statement. They still had the conditionality. Yes, they shifted slightly more hawkish, but they were very clear that they still want to see the inflation data. And more importantly, they still want to see the wage data. Now we know the wage data is coming up, what's it, the 18th? I think it's the 18th of May.
It'll be before before that big June meeting.
Yeah, so I mean, looking for it for the May meeting was just ridiculous to start with, right? I think June was always going to be the most likely scenario. Now,
and you think in June they'll pull the trigger? Huh?
Yeah, I think if we can see the wage index, we don't have to be at 3, but close to 3, they won't have. I mean, then they won't have any other reasons, right? Because they are projecting wage. I think the previous wage index came in at 2.4%. They are projecting 3% only in June next year. But if you take a look at all the Australian banks, I mean, Westpac, if you take a look at ANZ, all of them, they are expecting the wage index to reach, I think, 3% in this Q2 number. So if we get close to 3, I don't see any more reasons for them not to hike. I mean, it's going to be,
and the election will be out the way too. Those elections. Yeah. So yeah, interesting one. And Jen, just one liner. So would you be bullish or bearish on AUD then going forward if they do hike in June?
I'm for the RBA. I'm careful being bullish for the RBA. I think I'm still bullish at medium term. Short term, I'm a little bit more reluctant because it's seen so much upside in a very short space of time. We've got the virus situation playing out in China right now. I don't think that changes the medium-term view. I still think that China has the best chance of strong recovery this year because they are literally at the opposite end with everybody else, right? We've seen the CCP starting to create more stimulus. We've got promises of more massive infrastructure projects coming online. So I think China is basically at the bottom of the sine curve, while the rest of the economies is probably at the top. So from a commodity point of view, I'm still bullish the Aussie. From an RBA point of view, though, I'm less bullish than I was just 2 months ago when I traded it. For me, I think trading it, I think we caught the move early on in Feb. I think now trading it purely on the RBA is going to be more and more dangerous the closer we get to that first hike, because I mean, they're not going to get to 14. I mean, we're not even going to get close to 8 by the end of the year. If we do, the Aussie is just going to skyrocket with everything else going on.
But then that doesn't support the thesis of the global growth slowdown, does it?
Especially, but if it's China, right? I mean, if China can grow and all the others slow, that can, even though the Aussie is, I mean, very pro-cyclical, if the global economy struggles, but China does well, the Aussie can do really well in that environment. So that was for me, the biggest premise for jumping in early Feb is that if China did see a recovery while all the others slowed down, that's going to be great for the Aussie. And the reason why I chose the CAD is both of them is pro-cyclical. I think the market is way too aggressive on the BOC. If you take a look at private debt to GDP, I mean, household debt to GDP, government debt to GDP, if you take a look at house prices starting to roll over now, which is a little bit of concern for them. The economy is doing okay, but the BOC they're going to hike into a recession if they go, nuts in terms of rates. They're going to, it's the same problem in Australia as well. The household debt is so high. If they go too aggressive, too quick, they're going to cause a recession because there's so many variable rate loans out there right now in the housing space. It's a little bit jittery. So I like Aussie CAD, but we'll get to that. From a cyclical point of view. I think it's if in this environment, if the global economy is expected to slow, it's best to choose pro-cyclicals from a relative point of view and basically trade the one that you think is going to be better off, because that's going to be a way of, you don't have to be right.
Just have to be more right than wrong on the relative side. Yeah,
exactly. I mean, if you choose something that should appreciate in most environments, I like to focus my attention on those types of trades where I think that even whatever happens, I mean, look at the Aussie, right? You would think that in a geopolitical environment that we've just gone through, you would think it would fall off a cliff, but the Aussie CAD just kept grinding higher and higher and higher, and I think that's the point, right? It's that you're trading two things that move together, but one of these two is not like the other. It's you're playing that relative strength and weakness in the medium term, which makes sense.
Okay, perfect. Arno, thanks for that. We're getting on to the last two questions, and almost the most exciting part of the show, the trade idea. But just before then, how do you approach events trading? So, it's tough. We had the ECB meeting, their last meeting, and they surprised the markets hawkishly. We saw a knee-jerk reaction high, it popped up higher, and then it fizzled out and came back down to earth. So it's like, for me, it's like first you got to get the call right. You got to call that they're going to be hawkish or dovish. Or neutral, and then you got to call the reaction of the market correctly. And I don't think anybody could have said, okay, they're going to basically talk about like rate hikes ending APP sooner than believed, and then the market, the euro is going to rally and then dump. So how do you like to sort of close a trade before a big event, or do you maybe just widen your stop if you've already got a position on, or do you maybe not open any positions if you don't have any positions and open it after and trade the post event move? What's your logic and your process around these major events?
So, I mean, what's the way that I approach it, and I mean, I approach this process that I use it all the time, literally all the time, for any event whether it's an economic data point, whether it's a central bank meeting, whether it's a, geopolitics, doesn't really matter what it is. I have a process that I use, and it works for me. And it can work for you whether you're trading into or out of an event, which is great. I've always been better trading out of it though. I find that I'm not so good trading into it, because most of the time, the closer you get to the event, you probably missed the move already if you weren't in it from way before the event. I mean, you would have seen this already. If you're a week out, you're probably too late, to trade into it from that time. Not always, but most of the time. So the way that I prefer to do it, and I'm better at trading out of it, is the process that I use. The first step in anything is to figure out what the baseline is, right? So what is the market expecting from this event? Whether it's geopolitics, whether it's the ECB meeting, what are they expecting from it? Because your baseline will go a long way to explain the pre-positioning going into the event. So if it's something where they're expecting a lot of hype and it's there's a lot of hawkish expectations, or let's say it's CPI and there's a lot of upside expectations, you're probably going to see, or you should at least see, a strong bid in things like yields, in the dollar, if there's a strong expectation, right? So your consensus, the baseline, is the most important thing. You need to figure out what the market think is going to happen. What's the consensus expectation, right?
Yeah.
From the consensus, once you know what the baseline is, the consensus, that'll tell you. So then you need to ask yourself, what will surprise the markets today? So if nobody is expecting a hike, then the most outlandish thing would be a cut or a hike. So if the markets are expecting a hold in a hiking cycle, if they're surprised with a hike, that's going to be market moving, right? So you're not going to go so outlandish that in a hiking cycle you expect them to cut. You don't have to go that extreme in terms of your probability scale, if you will.
Yeah.
But ask from in terms of reasonable actions, what would be the most bullish, or the most hawkish, or the most dovish reaction from that particular bank on that particular day, based on the consensus? And I cannot tell you how many times, that has got me into the right trades at the right time, and also gotten me out of, the wrong ones. Is that if you know what the baseline is, and you do the prep. So don't do this 2 minutes before the meeting, for example, right? I find a lot of traders, they want to trade the event and then it's, it's 5 minutes away. Let me just quickly see what the guys are saying. Don't be that guy, right? If you're going to trade it, put in the time from a couple of days out, start figuring out what the consensus is, and then build yourself a hawkish and a dovish scenario, because that's really all that you want to know. Was the bank more hawkish than expected, or were they more dovish than expected? And if you know what the consensus is, you don't have to think very far to figure out what that surprise threshold will be. So a good example was when we had the February meeting for the Bank of England. I think it was the February one, where they surprised with, that's a good example of knowing the baseline and then the surprise. Everybody was expecting them to hike 25.
Yes, and we had those 4 descents. You wanted 50. Yes,
exactly. Yes. That is like a textbook example of nobody expected that to happen. So that's going to be market moving. Now, once you have the baseline, you figure out the surprise. Once you have the surprise in place, then you need to ask yourself, right, if I see my hawkish or my dovish scenario playing out, how does that change the bigger picture for the currency? And that is where I think, most traders struggle with. It's not with figuring out, wow, this was hawkish, or wow, this was dovish. It's what to do with that trade after it happens.
Yeah.
If the hawkish surprise wasn't big enough, or the dovish surprise wasn't big enough to change your bigger picture, the market's bigger picture view for that currency or asset, then you that's probably going to be a trade where you ride that spike higher or that spike lower, that 20, 30, 40 pips, and you get out. If it's something that changes the bigger picture or feeds into the bigger picture, that's probably something that you can get in and you can ride it out a little bit longer. So I think that if you don't know how that outcome will affect the bigger picture, that's where you're going to get burnt the most. At least that's how it's been in my case, is that when I've often got the dovish and the hawkish reaction right in terms of, wow, this was a surprise. But then if you hold on, like you said, with the ECB meeting, there's always the risk that on the statement, it's super hawkish. And then the ECB comes out and they paint a picture that says actually the bigger picture hasn't changed, and then you just see all of that moves go down. So if you're going to be trading events like that, I would say don't be greedy, right? If you've done the work and you know what that surprise threshold is, if you get in at the right time, you can make, I will never use the word easy, but that's probably the simplest and most, let's just stick with simplest. That's probably the simplest 20, 30, 40 pips you'll make out of a trade is if you get in at the right time. I mean, you could have made money on the ECB if you got out before the press conference, or at least took profit and moved stops to break even. So I think it goes a long way to know the bigger picture. But those 3 steps, mate, I use that for everything. Figuring out the baseline, then figuring out what would surprise the markets based on that, and then figuring out if either of those happens, how does that change the bigger picture? If it doesn't, it's probably going to be worth 20, 30, 40 pips, whatever. If it does change the bigger picture, that's something you can hold on to for a little bit longer.
Okay, that's a really nice framework, that one. And I think a lot of people will get quite a bit of value out of that. Now, finally to the most exciting part of the show. You're going to share your screen with us and tell us the trade which you currently like the most or have the highest conviction on.
Yeah, okay. So let me show you this one. So I'm cheating a bit with this one because it's something we've been trading. Just tell me if you can see that one.
Yeah, I can see it. So that's Australian dollar CAD. Okay. Yeah.
So it's a little bit of a cheat, this one, because we've been long this from the start of Feb. And the first trigger was when the RBA said, hey, we're not going to hike, but all the conditions for a hike is there. And that was just like, okay, so, we need to take some advantage of this. It was also China, the expected recovery taking place in China. So I like this to the upside in the medium term for a couple of different reasons. The reasons why I got long in Feb hasn't changed, but I'm not long this right now, which is why I'm saying it's a little bit of a cheat. I would prefer to show you something that I have actual skin in the game for. So currently I am long, euro sterling, I am long gold, but in terms of my highest conviction trade, I would say Aussie CAD and dollar CAD is going to be those 2 for me. So the reason why I like this to the upside, like we said, even though we're going through that virus situation with China right now, I think it doesn't change the medium-term picture. If you look at it from a sine curve, right? The way that I normally look at this is if you look at the sine curve like this, it's not the most beautiful one out there, but I think China is at this juncture starting to push to the upside, and I think places like the US, Canada, Europe, the UK, they are now at the top, and we're starting to slow down because China has already gone through their slowdown, right? They've already been slowing for the last, 18 months. I think from a sine curve point of view, if they can step up the stimulus, there's going to be a lot of support, and whatever supports China is going to be supportive for Australia, because 40%, right? 40% of their exports goes to China alone. So we know that's going to be important. If you take a look at this chart, for example, this is just looking at iron ore. All of these little highlights that I have in the chart, that's as iron ore started to drift higher with all the promises from the PBOC and expectations from the PBOC. So if we know that iron ore, LNG, coal prices in the medium term is going to stay supported based on China, I think that's going to be very supportive for Australian growth. And from a pro-cyclical versus pro-cyclical point of view, if you take a look at the CAD, I think the markets are getting very close to the top of that sine curve in terms of what's priced for the economy, what's priced for the BOC. I think if you think about it this way, if you think about the BOC between now and the next, let's say 3 months, do you think there's a higher probability that they will need to tilt even more hawkish than they are right now, or a higher probability that they'll need to tilt dovish, or at least not as hawkish?
Yeah.
My answer is not as hawkish, right? Probably more dovish than hawkish. So it's really a relative value play, this one, looking for the Australian economy to catch a bid on China and looking for the Canadian economy to actually, get a little bit of a struggle from the US economy. Because if you take a look at, let me just quickly get this on the screen for us. Sorry, that's not the one. There we go. So if you take a look at this, 70%, over 70% of exports from Canada goes to the United States, over 70%. So if you're thinking that your biggest trading partner is going to slow down, you know, I think growth estimates right now for Canada at what 4.2 or 4.1% for GDP, I think it's totally unrealistic. So I think that's going to catch massive headwinds. And if China slows, or if China accelerates and the US slows, I think that's a perfect Aussie CAD long, you know, idea right there. Just purely based on trade potential. Now, you know, we can always look at things like commodities as well. I think there's a higher chance, a higher probability that things like LNG, coal, not maybe coal, but LNG and iron ore based on China should stay supported. I'm less convinced about oil though. I mean, there's a lot of bullish talk about oil, but if we spoke about that demand picture earlier, right? If you think central banks are going to have to target demand, like seriously, if they're going to have to try to, you know, slow inflation by targeting demand, that's really been a positive environment for oil prices. So, you know, I'm reluctant to put only oil moving lower on the back of Aussie CAD, because I think there's more to it than just that. But I wouldn't be surprised, for example, if oil starts to slow in the next couple of months and weeks. We've already seen some downside, but I think that's just volatility, you know, finding some equilibrium in the oil space right now. But yeah, so I think based on the economies itself, I think Aussie CAD is a great buy, but I'm not in it right now. I'm waiting for deeper pullbacks, and I'm hoping that the BOC can give me that. So I'm hoping they come out so hawkish this week, right, that they surpass all expectations, that they promise the world that they're going to hike 50 this week, they're going to hike 50 in June, they're going to start QT. I mean, I hope they come out so rosy that we see decent downside in the dollar CAD and the Aussie CAD, and I would like to scoop up some bargains for those two. I think from a medium-term perspective, I struggle to see the downside case for something like Aussie CAD, given where we're going in the next couple of months. And the same one also goes for dollar CAD, right? Aussie CAD is the first one. I think dollar CAD is also interesting based on the reasons that we explained. So if you look at dollar CAD, let's just say, for example, that we do see that slowdown in growth accelerating. The only currency between these two that is expected to be positive in a slowing growth environment is the dollar. You know, whether you look at the Fed or the BOC or commodity prices, it's actually irrelevant. There's only one in a slowing growth environment that's expected to do better than that's expected to have a positive forward return, and that's the dollar. So I like both dollar CAD and Aussie CAD, but I'm hoping for better levels. I was in dollar CAD last week, took a couple of longs after that very hawkish comments from Fed's Brainard. I mean, wow, that was pretty hawkish on her side. But right now I'm waiting for better levels. But if you ask me, high conviction in the next, you know, couple of weeks, couple of months, I would say dollar CAD, Aussie CAD upside would be my preferred favorite trades, if you will.
And what levels would be where you would exit the trade, or where the trade would be invalidated, like, you know, the trade idea?
Yeah. So the way that I approach the trades is slightly different. So
okay,
I used to trade like a one and done trade, i.e., I have one clip running, I've got a set stop and I've got a set target. But the way that I prefer to do it these days is to be much more incremental. So I like to add in, if I open up any trade, I normally start with three entries, and that doesn't mean 3 times the risk. It's the same risk profile, whether you want to risk 1%, 0.5%, you know, it doesn't matter. I like to have 3 separate trades running, and I am very, very methodical in the way that I take profit. I take profit at key levels, whether it's 50 pips or 200 pips higher. I like to take off, you know, at key levels. So let me explain that just quickly with Aussie CAD, right? So our first trade with this was back on the 1st of Feb with the RBA meeting.
Yeah.
And I entered my normal, you know, three entries on that with my stop anchored. I think it was at below 88.50, I think is where I had my stop. I think that was the original level. And I had 3 units, and I took one unit off at key resistance, which I thought was 90.50. The next one I took off at just above 91. The other one I took off at 92.10. Now, I didn't re-engage the market. So normally my rule is that if I take one off and I see the markets being able to break break above and pull back into that level that I took off from, I would normally add a position from that level. I didn't do it with this trade, though. I was a little bit, because we were at the lows, it felt too much like a contrarian trade, if that makes sense. It felt too much like I was fading the market at the wrong time.
Yeah.
So I was positive on the trade, but I was reluctant on the levels, if that makes sense. So I didn't add to this, but that's where I would take it off. Doesn't matter what level it is. If I think it's a key level, I'm going to take some profit off the table there. And then what I did is, unfortunately, because I was out of the trade at that time, I missed this nice little, rush to the upside. But I stayed patient. I stick to my rules. I said, I'm not going to buy a compromised position. Like we said with dollar yen, if I miss the initial push, I'm going to stay out. I'm not going to risk getting in at a bad spot. Waited very patiently. My trigger for re-entering this, we got back in from 90 to, I think it was 90 to 0.50-ish from about this level. My trigger point for that was that very hawkish comments we had out from China, where they said they're going to support the economy. They're not going to allow the stock market to fall. I mean, what? You don't hear those types of comments coming out from China. So that, alongside the fact that I think we had a Canadian CPI coming out at that time, and my rationale for that was, okay, we're either going to see a massive upside surprise, or we're just going to see a fair beat. That's not going to be enough to see the markets pricing in a more aggressive path for the BOC. And I jumped in from that level. And I traded that the exact same way. I took profit when I reached this first key level of resistance, which was 92.80. Traded it to the upside when I reached the next one. Traded it to the upside when I reached the next one. So currently I'm flat on it. Not because I don't want to be long, it's just because I ran out of positions. So I ran out of my 6 positions, and now I need to add back in. Yeah. But before I add back in, I will look for decent downside. So I think for Aussie CAD, what I like is if we could get a retest of this major trend line, well, not a major one, but this medium-term trend, we had a nice false break of that. I think if we can get anywhere between 90, let's say 93 and 92.50, I think that level could be really exciting to get back in on the long side. Obviously, again, the reasons for getting there will be important.
As you said earlier, the conditions. The
conditions needs to still be favorable for the trade. But I mean, if we can get back into this zone, I would really like it. That's the other thing is, as I said, I split those positions up normally into 3. I start with 3, and those 3 doesn't have to be entered in at the same time, right? If I'm long something or short something, I could potentially build into that 3 positions as the market moves. So sometimes I would like to put in one clip at basically 30% of my normal risk. I would add in one and see whether the level I'm looking at actually holds, because oftentimes the level doesn't hold. It breaks lower and then it breaks back up, like a false break. Like this level was a good example of that. So sometimes I will add one in and just see how the conditions develop. And then as it starts to pan out, whether we break higher and pull back or whether we pull back from where I entered, I can always add one more position, but I'm never adding risk to my trade, if that makes sense. If I normally add, let's say, 0.5% risk, I would split that 0.5% up in those 3 positions. And depending on where I enter, obviously need to volatility adjust that based on where I have my stop. But you don't have to go, all in, if that makes sense, from one spot. You might enter one position over here, and then you might enter another position over here, for example. And maybe if you break lower, you have one more shot left, basically, one more bullet in the barrel, and you can enter from a little bit lower. But you're not averaging into a trade, because that's something that I don't really. It's something that I don't think is always a good thing to do. It's more a case of building into a core position around a level that you like, because I spent so many times previously being so surgical in my entry, right? It needs to be that level. I'm getting in at that specific spot, and I missed great trades so many times because of that. So these days I'm giving myself a lot more room to breathe. If I get an entry in an overall zone that I like, whether that's a 50 pip zone or a 60 pip zone, I would take any entry within that area and I would be okay with it.
Arno, this has been absolutely fantastic, and I'm sure anybody who watches is going to gain a lot of value from it, and hopefully, maybe they might even make some money on the trade.
I mean, I hope so. I hope so. If they don't, I'm going to change my number. I'm going to change my handle on Twitter. They won't get me.